Asset turnover ratio. The asset turnover ratio is a straightforward measure of how efficiently a company uses everything it owns to generate sales. It looks at how many dollars of revenue come from each dollar of assets, comparing net sales to total assets. This tells you whether management is smart and effective at turning investments into income. Let's walk through the formula. Asset turnover ratio equals net sales divided by average total assets. Net sales comes from the income statement, while we use average total assets, that's opening plus closing assets divided by 2, to smooth out seasonal swings and one-time purchases. For example, Company A has a ratio of 2, meaning it generates $2 of sales for each dollar of assets, while Company B's 0.8 shows it's less efficient. A high asset turnover ratio means you're generating more sales from each dollar of assets, which signals efficiency. But what counts as a good ratio depends entirely on the industry. Comparing across different sectors can be misleading. Most importantly, focus on the trend over time. A rising ratio shows real improvement, while a steady decline may point to overcapacity or declining sales. Asset turnover is only half the story. You also have to consider profit margin. High-volume businesses like grocery stores often combine high turnover with thin margins, while premium brands like luxury goods run low turnover and high margins. The DuPont analysis links those two together with leverage to fully explain return on equity. When using the asset turnover ratio, it's easy to trip up if you ignore intangible assets like goodwill. Focus instead on tangible asset turnover for a clearer picture. The most common mistake is comparing companies across different sectors without considering their asset intensity. A utility and a grocery chain will naturally have very different ratios. Also, remember to use average assets instead of just year-end figures, and watch out for capitalized leases under ASC 842 that can artificially inflate total assets.